Greetings, traders. It is I, Abdul Shabazz, and this is some real change. Stock option trading journey. And today, December the 18th, this wonderful Wednesday that we have upon us, this wonderful Wednesday. So grateful for you guys tuning in, and so grateful for you guys who are also watching the replay. Hope you're learning and look forward to you guys joining us live. Got an announcement to make. Want to wait until the usual suspects start showing up, and soon they will be here. Dr. J is in the building. Shout out to you, Dr. J. Huge gap up from yesterday's close of 604 all the way to 606, just for the market to have a sell-off after we reach the 606 pre-market, all the way back down currently to the 604. Keeping in mind, today is FOMC Day. I do like this 604. Very interesting day today, guys. At this 604 level that we're approaching at market open, right back in the area of yesterday's trading. Top right daily chart. The bottom right is the weekly chart. Here in the middle is the 30-minute chart. And to the left, we have the 15-minute chart. Above that, to the top left, we have the 2-minute chart. And sometimes we switch that to the 1 minute. Right now, it's set on 2 minute and on Heikin-Ashi. I'm going to go ahead and maximize it so you can see the action from yesterday's close. Dip to the 602 post-market, and then a run all the way from the 602.8 to the 606. With the anticipation of today's open, the market had a sell-off at the 606 and has been dropping ever since. Interesting to see how this day will go. Keep in mind, today is FOMC Day. Todd Macon is in the building. Shout out to you, Todd. Thankful and grateful that you're in the building with us. Want to be extra careful today, as today is FOMC days, and a lot of professional traders do not trade FOMC. Rather, they use that to ascertain how the market is going and what the market might end up doing for the rest of the week. However, if you do decide to take a trade today, there might be one good trade this morning, and then after that, a little bit of chop. So let's take our time today. I will be observing, unless it's just a gimme. I mean a true blue A++ setup. Other than that, I will be observing the movement, observing the implied volatility for today. pretty much basically taking my time. Brooke Sanchez is in the building. Brooks, I was just telling Todd and Dr. J and the rest of the people who are on here that today is FOMC Day, and we want to remember not to overtrade in this morning session. We want to remember that 2 o'clock the reports start, and then at 2:30 Powell comes out and speak. And just a reminder to the team and to those of you who are listening, most professionals do not actively trade. FOMC days, they use it for guidance as to what is ahead. If you do decide to trade, please reduce your size this morning, and please only move off 100% solid setups. I myself will be here in the background, taking my time, looking to see if a give me pops up. Expect a lot of volatility this morning. Don't want to get anyone confused. So we're going to go ahead and just jump right to the 5-minute chart. And I'm going to go ahead and include pre-market so you can see this controlled selling that we're in. Bam. There it is. Go ahead and give you that view for right now. Yesterday's action, post-market, pre-market, and now market open. Give us an idea. I'm going to go ahead and rock with that view for right now, guys. I really don't want to get anybody confused, so I'm not even going to highlight these algos. Don't forget, at 2 o'clock, the FOMC statement is released. Please expect some whipsaw today. The market will react to what is seen in the reports. Then you will have the question and answer after that. So, everybody relax and know that today's action is probably going to take place at 2 o'clock if you decide to trade today at all. A 603 is still a very important area. At 603, the Bulls lose control of the month. Mentioned this early yesterday morning, and what happened? We had a push down towards that area. The Bulls were very fearful, very early, reject the lower prices at the 603.2, bounce back up to the 605, and then finally hit it. And once they did, the Bulls came back in very strong, took the market right back up to the close of 604. But then post-market, the Bears are able to bring it right back down again. Again, the Bulls find this as a very attractive price, an area of price, and they started buying all the way up to the 606 that we came into pre-market. And from then, we have been selling off. FOMC today, please be careful. There will not be much commentary until 2 o'clock. Let me go ahead and type that in the chat.
Lights are going up, snow is falling down. There's a feeling of goodwill around town. It could only mean one thing. McRib is here. People throwing parties, ugly sweaters everywhere. Stockings hung up by the chimney with care. It could only mean one thing. McRib is here.
At participating McDonald's for a limited time.
For the one ones ensuring the job always gets done, and the ones wearing many hats. Grainger offers professional-grade industrial supplies and real-time product availability. Call clickgrainger.com.
Cox multi-gig speeds. Power all your devices at once with Cox multi-gig speeds.
answer is...
You cared about that.
Last year, I think down double digits against the dollar.
Yeah, for separate reasons it really popped, but it's worth watching EM here.
Welcome back, TK. I've missed these conversations.
It's just
going out there, bringing up Hungary. Do you remember those Swiss franc mortgages all those years ago?
Yeah, the Swissy foreign mortgages.
Who would have thought we'd be talking about this 50 seconds out from the decision? But that was a real thing. That was a problem in the day.
Actually, right now, there are nodes of that happening in different places. I mean, check out what's going on in Brazil.
Let's hope that Brazilians haven't been taking Swiss franc mortgages, because they've probably been in a lot of trouble after the performance of that currency this year. Let's turn to the scores. That decision is 30 seconds away. Equities on the S&P 500 positive by 0.2% on the S&P. Some outperformance so far this afternoon on the Russell. The small caps up by 0.65%. If you switch up the board and get to the bond market story, check out the yield curve. We'll slice this up on the 2s, the 10s, the 30s. Yields are coming down at the front end of the curve by about 3 basis points to 421.30. On a 10-year, we're down a single basis point to 438.29. With your Federal Reserve decision, the overwhelming consensus saying a 25 basis point cut. Here's Mike McKee.
It is a 25 basis point cut, and the number of cuts forecast for next year has been cut in half to just 2. Another 2 are seen in 2026 and 1 in 2027. And as the long-run Fed funds rate expectation rises to 3%. If that's basically seen as Fed officials' view of the neutral rate, they won't get there under this dot plot until 2028. We have one dissent. New Cleveland Fed President Beth Hammack casts her first, preferring to leave rates unchanged. Interestingly, 3 other members of the committee, presumably non-voters, agreed with her. 10 members see two cuts next year. 5 see 3 or more. 3 forecast 1. And there's 1 member who thinks optimal policy would be to leave rates unchanged all of 2026 and 25.
Big Money said, watch it only.
They now promise to carefully
assess
incoming data, quote, in considering the extent and timing of additional adjustments to the target range for the federal funds rate. There's no change to the committee's view of inflation, which has, quote, made progress toward the committee's 2% objective. But
don't forget we have Powell doing the Q&A at 2:30 also.
However, show both PCE headline and core inflation forecasts revised up significantly. Headline will be 2.5% at the end of next year, up from 2.1 forecast in September. The core also 2.5%, up from 2.2%. They do see unemployment at 4.3% at the end of next year, which is down 1/10 from September.
Let me look that up real quick.
This year with GDP up 2.5%. That's a 0.5 percentage point jump from their September outlook, and it is going to grow 2.1% in 2026, a significant slowdown. In one technical note, the Fed did lower the offering rate for overnight reverse repurchase agreements by 30 basis points to 4.25%. That's the same as the Fed's target range lower bound. Guys?
Mike McKee, thank you, sir. There's so much to unpack here. So let's just go with 2025 and go to the forecast. So we get a 25 basis point cut. And then they do this for 2025. GDP revised higher. Unemployment revised just a little bit lower. Then go to PCE. Once again, revised just that little bit higher. So what do you get for the dot plot? The median dot was actually pointing towards 4 cuts for 2025. They've cut that in half to 2. which basically marks the whole thing to market. This is where the market was, looking for 2 cuts in 2025, and this is what the Fed is projecting, if you consider this a projection in the median dot. Turning to the price action off the back of this, we unlock another dose of dollar strength. Euro dollar breaking down to 104.44 off the back of that move in the bond market, with yields higher at the front end of the curve on a 2-year up by 3 basis points to 4.28, on a 10-year up by a single basis point to 4.41. In the equity market off the back of that, we come off session highs. On the S&P 500, we are just about unchanged. So if you are just joining us, welcome to the program. It's a 25 basis point reduction from the Federal Reserve with a sprinkle of dissent and some big changes, Lisa, to the forecasts for 25 and beyond.
And what you can see is basically the market readjusting, but not necessarily a freaking out. I think it's fascinating, the idea that Beth Hammack, the new Cleveland Fed president, is the lone dissenter. 3 non-voting members, as Michael McKee said, seem to have agreed with her. To me, this is the definition of a hawkish cut. We now have 100 basis points of rate cuts since that September meeting. Now they seem to be only baking in 2 rate cuts, as you said, and it raises a question of what the parameters are, what the messaging will be from Fed Chair Jay Powell.
Compare the September forecast to the forecast we just got. Where they thought Fed funds would be at the end of next year is now where they think Fed funds will be at the end of 2026.
We just flipped for the day.
They've pushed the whole thing out 12 months. Now, the debate we're going to have, and no doubt the debate they'll have in the news conference with Chairman Powell and the journalists.
We're now red for the day, guys.
The data we've had since the September meeting, and how much of this is about assuming, speculating, guessing what's about to happen with policy.
Well, and ultimately, how much can they divorce the two if they're looking for signals from the collective betting agency, the collective wisdom of the crowds of markets? At a certain point, they have been following the market in certain aspects. And in this case, the market is inferring certain things about policies, and the Fed cannot ignore that. But I want to hear from Fed Chair Powell this afternoon in just about 25 minutes' time. What is your scenario analysis? How do you take into stride the prospect of both tariffs as well as potential changes to immigration?
To me, the character of the dissent's interesting. I don't have time to study it, but the uniqueness of, she's quantitative economics out of Stanford. She certainly knows her way around the block, but that's something. Your first meeting and you dissent? I mean, what would Alan Greenspan say to that? That's like Lawrence Meyer 101. But the answer here is the markets are moving. I'm looking at yen out to a 154 level. Damien would look.
Don't forget how important that 603 is, guys. My goodness. The 603 is so important.
This is what they call a hawkish cut. I could not agree more. And that's judged by what's happening at the front end of the curve. Even as they reduce interest rates by 25 basis points, the 2 years higher by 7 basis points. We're back through 430. Bob Michael at JP Morgan's had some time to go over the statement, to go over the projections and the market reaction. What do you make of this one?
Well, I think they have an incredible sense of self-awareness, that the economy looks great. The fourth quarter is going to come in around 4%. You've got unemployment at 4.2%.
I had to take it, but I'm going to get out right now.
That's a pretty good level to be at. Inflation's a little bit above their target.
I had to take that. That 603 line was way too important. I had to take that give me that it gave me, guys. Please excuse me, but I had to take that. I'll give myself a little slap on the hand.
And they have to begin to model that. I actually think that.
But I had to take that because that money. They were just giving that money away. The 603, if you guys remember yesterday, I told you at the 603, the Bulls give up the month. This is now currently a red month. So I know breaking through that 603, looking at that clock as I was looking, I said, man, this candle is going to pay. And boy, did it. In fact, I kind of got out a little prematurely, but I stuck my hand in the cookie jar and got away with it. Now I'm back to watching. But that was a very quick 30-cent move. So, I mean, I had to get that.
A lot of the currencies and bond markets
I had to get it.
Do you think that it was a mistake?
Back to the sidelines. Again, this is so important. This 603 is very important. How are the Bulls going to respond here? Are they going to give up the month? We went down to 601. It's amazing. Now, I want to show you guys something. Look at your screen.
they don't.
I knew that the 6015, I'm not going to say I knew, but I called out and written out earlier that the 6015 was potentially to be hit. You see it right here on the screen. The 6015 and the 6025. Both of them just got hit on that drop. That's why I had to jump in and take that. Because it was already written down.
That's what you're getting at the Fed, which is, you know,
And I could only see as far as the 6015, and that's exactly where we are here, the 6015.
the consumers looked pretty good. What are we doing cutting rates further?
I look at this, John.
The market didn't show me anything beyond that,
Canadian dollar.
but that I saw, so I had to take that trade.
But it's a jump condition, unlike others which are just pushing up as well.
They've got their own true-day shape problems, Tom, and Europe's got their own problems too. Euro dollar right now breaking down to 104.20, just about holding on now to a 104 handle. There's one question I've got for you, Bob. It's a forecast we haven't talked about. The longer run dot, it is inched up by like that much, from 2.9 to 3. Is there not a bigger realization going on at the committee that needs to come up a whole lot more? Why is this taking so long to draw that conclusion?
My goodness.
I think the realization.
Googity Bob.
And I think having a dissenter on.
Googity Bob. Please believe it's going to be a huge bounce. Don't worry about the chase. Don't worry about chasing it.
That does seem pretty high. We had.
You know that body dip crew is not going to let the day end like this. Think about all the people who missed the market at 600. Missed that run up. This is now giving them another opportunity. Don't forget the instrument that we trade. That is the S&P 500. Do I even have a line down here? Oh, I do. Well, what do you know? I do have a line down here. And guess what the line is? The 600.
Yeah, I think that's only part of it. It just takes a weak labor plan over the next month or so. It takes a surprise to the downside in core PCE. One of those things to remind the Fed that this level of rates with a 4 handle in this economy,
I even had plans for this.
Zero interest rates is still somewhat restrictive, and there's more work to do.
If you are just joining us, welcome to the program. 10 minutes ago, a 25 basis point reduction from the Federal Reserve. A sprinkle of dissent, but that's not where the headlines are. The headlines are in the summary of economic projections, released alongside the statement from the Federal Reserve, where they increased their forecast for GDP for 25. They took down the unemployment rate forecast. They pushed up the forecast for PCE, and they did this with interest rates, projecting rates would drop
this thing went
to
nuts.
when previously they were looking for 340. So the Federal Reserve essentially, the median dot, has gone from projecting 4 cuts in 2025 to just 2. Off the back of that, in the bond market, yields are higher, the dollar's stronger, and equities are rolling over. On the S&P 500, we are down by 0.6%. To weigh in on this, Diane Swag of KPMG joins us now. Diane, you've had some time to pore over all of this. Let's start with those projections. Was that in line with what you were looking for?
Actually, it is, and I'm glad to see it. I thought that the Fed was going to, if they were going to do a quarter point, which was already priced into the market, that they had to scale back dramatically, at least by half, their forecast for rate cuts next year, which is what they did. And the disagreement within the committee is exactly what you would expect. There's a lot of debate right now about how close are we actually to neutral. And in fact, you know, the new Cleveland Fed president was one of the ones that said we may be closer than you think. So it's not so surprising that she cast a dissent, even though it's her first meeting. It's also her last meeting to vote before we see Austin Goolsbee roll.
The bounce is going to be epic.
In January as a voting member.
The bounce is going to be epic.
At the meeting that also agreed that they don't want so many rate cuts next year. The economy, they can do it without front-running any policies right now.
You don't want to catch a falling knife.
Much stronger than they expected.
Look for support.
To both employment and inflation's come in hotter, and the consumer is
look towards support.
And the world. at this point in time, and that's important. I think it's also going to be
bounce
really
is gonna be
important to see
epic.
in the discussion and in the minutes to this how much they talked about that consumer sentiment number that showed people buying ahead of price hikes and that hoarding activity, which suggests that perhaps inflation expectations are not as well anchored as they thought and have become a bit more moored in the post-pandemic economy.
Diana, your Illinois is the 5th largest state economy. It would be the 18th largest economy if it was a country in the world. And yet we perceive Illinois not flat on its back, but a much more diversified, struggling state. What do you see out there about the two Americas that you would tell Chairman Powell?
Well, I don't need to tell Chairman Powell anything because he spends a lot of time looking at both Americas. I think people don't realize how much time he spends talking to people who are trying to upskill themselves and get out of being paid by the government and get training, especially single women with children. I know how much he spends time. He doesn't want to spend time just talking to executives when he goes out to all of his regional visits at the Fed. He actually asks to see the underbelly, to see where people are struggling, what's really going on. I think what's important, I think about this in my own situation. My son, when I asked him what he wanted for Christmas, he asked me to donate to the homeless. And the working homeless are a real problem. And I think that is one of the issues that we're struggling with. And interest rates alone coming down are not going to change the supply of.
Do you know the U.S. solar company's nasty little secret? It turns out if you live in Virginia, they have to give you solar panels for absolutely no net cost.
And bid up by a whole host of factors, including scarcity of labor and these recent disasters that we've seen, which are pushing up the costs of actually construction.
Because of this fragility, and Bob, I'm curious your thoughts. Some people are saying that essentially this is a hawkish tone, but this still is a Fed.
Yeah, it went right through the 20, Lance.
Again, that is the comment from Neil.
It went right through that 20.
The hood of some of the employment
I think we're gonna look more towards the 600 personally. Who knows? Nobody knows because you still got Powell coming on. So
because they're telling us they're rethinking how many cuts they have to do, and certainly by the time they meet again,
I'm gonna show you something on my other
going to hear a lot more from the administration.
plans. I had long-term plans to get in a 602 put, take that down, add at the 599, go to the 598, even the 595. So that's how far I see us potentially going down. But I just didn't want to trade on today, but I had these plans written out. Beginning at the 604, starting at the 604, going to where we are currently, and there's even room to go further down. Much more room to go down.
And then all of a sudden stops as Trump walks through the door. Diane, how much of these moves, the change to the forecast that we're seeing, are about the incoming data?
Damn, I was in that thing. I shouldn't have got out.
Is about expected changes to policy.
That thing is up damn near 200% right now. You gotta love it, man. We're at 600. We're at 600, guys. We're at 600. Back at it. What a move. What a move. Look for support here at the 599.8. Come on down. I see you. Come on down. This is where I want you.
Front running any policy. They did cut at this meeting. If they were front running policy, they wouldn't have cut at this meeting. And I think that's what Powell wanted to say, even with a dissent, with this hawkish tone. This is sort of the perfect way for him to say, we're doing our job, we're looking at the data, it's coming in stronger, the economy is solid, and it justifies higher rates. Now, you always worry about what's going to break going forward. The administration coming in, they will have more information on it, but even tariffs take quite a while to kick in. They don't kick in overnight, and I think people forget about that, and we don't know what, not only will the tariffs completely look like, we have ideas and we can model out scenarios, but retaliation will be designed to disrupt supply chains. That's very important because when you're thinking about it that way, that is inflationary, and we're in a much more fragile supply chain.
Guys, do you know that this is all within 30 minutes? This is a 30-minute candle. Have you seen the 30-minute candle? Unbelievable. $5 drop in the 30-minute candle. A $5 drop has taken place in 17 minutes.
And I think the Fed is still hoping to hit that soft landing. But a soft landing, really, they will not declare victory. And this will not be Chairman Powell that we saw a year ago, who was pretty jubilant a year ago when we were sitting in this exact spot. I think you're going to see a Chairman Powell that is cautious, optimistic about the economy, talking about the strength of the economy. That's why they're doing what they're
Guys,
doing.
let me tell you why we all should be so excited, because we are now back into an area of levels. We're back into an area of levels. Come on, 599, 8. Come on.
To the FOMC decision, and they're unwinding some of that. We'll see where it closes. I'm pretty optimistic things will settle down. I think Diane said it correctly, that this is still a Fed that cut rates in front of incoming policies. So they must see something in the improvement in inflation that they like, and they must see something in the labor market that they want to make sure doesn't metastasize.
We'll find out more in about 11 minutes' time when this news conference starts. A special thanks to Diane Swank of KPMG. I want to draw your attention to what's developing in the FX market and elsewhere. So we'll start in the bond market. Just a flavour of that. Yields up on the front end by 7 basis points. The 2-year back through 430. If you take that move, just push it through foreign exchange. What do you expect? Big moves in G10. The dollar stronger against absolutely everything against the majors in G10. Beyond that in EM, Tom, 2% move against Brazil.
2 against a -6. Well,
that's another 2%.
Each of them, yeah, but each of them are idiosyncratic.
On top of the 20 so far this year.
Yes, you got Turkish lira popping through 35 today finally, but they're each a different story. But as Damien Sansauer says, who's expert on this, it is a flat-out 6% depreciation in EM currencies. And John, I'm looking at the drawdown in the Standard & Poor's 500. I'm not using the Dow here. And the SPX is, we have a drawdown of a negative 1.5%. There's carnage out there.
Session low, we're down about 0.7% on the session on the S&P. Matt Lazzetti of Deutsche Bank joined us now. And we teased this one up, Matt, a little bit earlier in the program. We said Matt Lazzetti is looking for one more cut, said it was a close call for December, and then ultimately, you think they're done for 2025. Matt, are they getting closer to your world?
Well, yeah, I mean, you have to say that the dots move closer to that world today. I think really importantly within the SCP, obviously a lot of focus on the dot plot, but what drove that was this big upward assessment in inflation. They moved up their core PC inflation forecast to 2.5% next year. That's closer to our own view. They moved up their core PC inflation forecast for 2.2% in 2026. Really takes till 2027 really to get back to their inflation target.
I want to buy, Jody.
Big reassessment of the risk assessment around both the labor market and inflation. Risks to the upside of inflation, everybody kind of anticipates a move back in that direction, and they're much more balanced risks to the labor market. So it's a kind of an SCP from a forecast perspective and from a risk assessment perspective. It looks a lot more.
I mean, I accomplished what I wanted to.
Matt, how much do you think this really is stemming from the data that we've gotten of late versus just a promised change in
I'm just excited we're moving. There's going to be a lot of potential these next couple of days. A lot of potential, but I really want to buy right here. I really want to buy right here. I see the signs. I see it. 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 I had to get it. Okay, guys, I just took a small call position right here. I am going to hold it and guard it with my molar teeth. Hand is right on the trigger, ready to get out at the slightest reversal. But there's going to be a breather. That's not calling for a reversal. That's not saying we're not going to have further move down. But I'm just trying to see if I can catch this breath real quick. That's all I'm doing. Please do not follow me.
Matt, is simple. I don't know why the Fed cut. Matt Lazzetti, why did the Fed cut?
I think it's a great question, and
But this is our first green candle.
we thought that there was a lot of good reasons.
Now, of course, the bears could use this as liquidity to get down to that 599.8 that we were calling for. But I at least want to maximize this one 5-minute candle. So I do have my hand in the cookie jar.
The risks assessment from a labor market inflation perspective at this point in time. So I think that'll be the argument at this point. That said, I think the signal from them is that they're not just on this regular cadence of rate cuts. They're not just kind of on a path, a smooth path down to a neutral rate that is kind of uncertain. That it does look like they are going to be pausing for a bit longer here, given their baseline forecast for the data. And that's in line with our own expectations, that the data flow, we think, over the coming months and then coming quarters will just not be consistent with dialing back more restraint.
Tom, I thought that was a great question, and I'd like Bob's answer, because honestly, I think that really is a key question, and it's going to be very difficult for this Fed chair to really answer. If you actually are upgrading your expectation for core PCE, why did you cut it all this meeting?
Yeah, and so Matt may eventually be right that this was the last one. As he was talking, I was thinking, boy, this is really reminiscent of 1995 when they had hike rates from 3 to 6%. Everyone thought they'd have to cut rates to 4. They did 75 basis points. That was it, 5 1/4, and then they came back shortly thereafter, starting to hike rates. You do look around.
She breaks 601. I'm getting out.
Actually, the economy's doing pretty well. Now, there are things below the surface in the labor market they have to be concerned about.
I'm still looking at the clock within this 5-minute candle. I'm giving myself this 5-minute candle. I've also given myself the 601 as my exit.
108,000. Haven't seen that since 2010. So why not continue to take?
But if we can close above the 601.45, that will start some profit taking. 10 seconds left in this candle. 601.45. Looking here on the left, we want to see the bulls. We want to see the bulls stack above the 45. We did get that. Oh, whoa. Where we at now?
Could be right. It could be here. We'll find that out by March.
Matt Lazzetti, what's the elasticity here? The Atlanta GDP statistic is 3.1.
There we go. There we go. Come on.
Slower economy, or do you really
Come on. I just need 5 more minutes before Powell starts talking. 5 more minutes, guys. Let's go, Bulls.
You see the past several quarters, 2.8% growth in Q3. As you mentioned, Q4 tracking at above.
I move my stop up to this candle.
Forecast is for 2.5% growth next year.
If this candle turns, I am out.
Financial conditions are easy. Credit conditions have eased. Sentiment has improved. So I do think this economy has substantial momentum behind it, and I think can give you strong growth outcomes. One thing I'm a little bit surprised about is actually their potential growth estimate remained at 1.8%. They've been
Alrighty, good enough for me.
The supply side of the economy.
Stuck my hand in a cookie jar twice and got me a cookie.
Maybe that's in the coming quarters.
Matt, what would you want to ask Jay Powell at a time when everyone's going to try to get him to comment on Trump policies and everyone's going to try to understand just how high...
I promise you, I'm on the sideline right now. I am shutting it all down.
You know, I was going to ask about kind of the level of restriction if they had 3 cuts.
Hands are sweaty.
Understanding how they're thinking about a few things.
Palms are wet. Hands are sweaty. I'm not even eating mom's spaghetti. Boy, this FOMC is doing a job on me.
I think there's many reasons for them not to. Payroll gains are stronger. The quits rate has moved higher. The hiring rate has stabilized a little bit. Job openings have picked up. But are they as concerned about this rise in the unemployment rate as they were during the summer? Second question, I think, is on shelter inflation. We did have this big downdraft in the latest print that went against Chair Powell, saying that it was going to be a very slow progress on this front. How are they just thinking about over the next several months? I think is an important question for them as well.
Matt, there's one big problem I've got with this decision. And it's the words the chairman used in the last news conference. We don't guess, we don't assume, we don't speculate. That inflation forecast, Matt, are we sitting here and really saying that much has changed in 2 months that warrants the upgrade to that inflation forecast of the FOMC without guessing, speculating, or assuming on what policy is going to do?
So our own inflation forecast is 2.6%. That builds in about 20 basis points from tariffs. So they'd be a little bit more hawkish on the inflation front than we would be. Just going back to 2019, I don't think they're really building in tariff effects explicitly into the forecast as of yet. I do think that is factoring into the risk assessments that we see in the back of the SEP, where everybody kind of shifted back towards upside risks to the inflation front. But that should also make you worried to a certain extent. If their baseline is 2.5% without tariffs, it'd be even higher than that with tariffs, which are likely coming, and therefore they'd probably be taking out even a little bit more of those rate cuts that they were anticipating, which was already leaning in a hawkish direction.
No doubt you'll hear lots of questions about that about 3 minutes' time when this news conference starts. Matt, we'll let you run. Matt Lazzetti of Deutsche Bank, Neil Dutter of Renmac writes in, talked about him a few times already this afternoon. The Fed is prejudging policy. That's one view. That's Neil's view.
Yeah, and he's talking about the fact that there has been such a huge shift without some sort of massive change in the tone of the data. That I think people will disagree with. We have some people who say the data has come in a lot hotter. Nonetheless, they have a lot of things to explain in this press conference.
Bob Michael, are they speculating? Are they assuming? Are they guessing at the FOMC?
Do you know what? Their inflation forecast just struck me as frustration.
Frustration with what?
With the stickiness of inflation. It should be 1.9 to 2% by now. Look at how the labor market has loosened up. Look at how growth has slowed down. And here we are, still around 2.25 to 2.6%. I don't read anything into it more than that.
So basically, do you think that at this point, this is a Federal Reserve that basically really is just throwing darts at a dartboard?
I think they have to be because they don't.
Well, that's essentially what he's saying, but carry on.
They don't know what. By the way, back in 2009, they would have forecast 2.25 to 2.5 because remember they had the flexible average inflation targeting. They wanted higher inflation for a period of time. And that's what existed in '95 during the last soft landing. Now, they don't guess, speculate, but they model. And they've modeled
sort of
something.
The same thing.
Yeah, well,
I brought this up to you on Hollenhorst. Let me bring it up with you. It's real simple. Are they going to stay on an ex post method that they've used for 400 years? Or are they actually getting out front and predicting? I don't buy it. They got to be ex post. They got to wait for GDP to crack, for unemployment to get to 5%.
Right now, they have.
Just as the market was showing us, it used that 5 minute just as a breather.
This was fun. It's good to see you, sir. Almost there, almost at the holidays. After this is like kind of it for many of you I know going into year end.
Hello, 599.8.
We'll be here, but sort of psychologically we'll be somewhere else.
Okay, you keep saying
after we wrap up this news conference.
So you want me to still come in tomorrow? And
I'm going to be here. You're going to be here.
Are you going to be here? Or
TK's going to be somewhat checked out.
You're actually going to get to go off.
No, TK's not here physically either, right?
Yeah, exactly.
You're done.
I didn't take a vacation day until the Red Sox were eliminated. Okay, that's my tradition. So that got me to May 10th.
Nice.
And so thank you. So, I'm taking a couple days off. I'll be here next week to pick up the pieces.
Well, the chairman's here. Right
Oh my goodness, Becky.
And catch up with the chairman of the Federal Reserve, Jay Powell, after reducing interest rates by 25 basis points.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal.
Good place here to
We're
look for a
committed to
bounce.
maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smilik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call.
We empower those who act, those who see the correlation between predictability and probability, those who manage risk by anticipating each movement, flawless execution, timing, and accuracy.
Too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecast at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation to as I mentioned. As we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, it considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect, tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work. All of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling, so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence, or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates, and we made look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. You do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on, and our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation's moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are, we think, are roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think.
Do you know what's really fun? Making a website on Wix.
Hey, we're how ridiculous.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
I promise you, we're going to get paid off of these picks one day.
Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios.
I saw this coming the entire time.
Are you comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your
I'm going to even pull up Monday's plan so you can see it.
That's part of what we do, but we really look carefully at is the performance of our
on the replay. But I'm just so excited about our future, guys.
Of course of just take the last year. We've seen inflation, over the last couple of years, come down a lot.
All we need to do is work on our discipline. The eyesight is definitely there.
Our policy is restrictive. We can also look more directly at the parts of the economy that are affected.
Because once you see it, somebody put it in the chat, please.
Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggles with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to
We've got levels, guys. We've got
the
levels.
unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so, no. I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation, and that's part of the reason that explains why we moved ahead today with the action with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Thanks.
Amira. Thank you, Amara Mokwe from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So, I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that, and it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices, and that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there, so that people are earning, big real wage increases, so that their wages are going up, their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What % do you see and the committee believes? Where is that neutral rate?
So I'll say a couple things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy, and particularly we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be there are things that affect the economy that are lasting but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in, and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously, now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation, because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation, because that's what people experience. People don't experience core inflation, they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah. So headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out.
Today is a good day to be a trader. There are a lot of sick people right now looking
in the economy.
Today to be a trader. There are a lot of sick people right now looking
in different directions. Headline has been lower. As you know, most of this year, that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
So we monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks nothing has come out of those risks.
I was saying today is a good day to be a trader because we have the ability to get in and get out, recognize opportunities, recognize when things are falling apart and stand aside. There are a lot of people right now who are very upset and very sad looking at their long-term portfolio. Other people are looking at this as a great opportunity, as that is exactly what this is, a great opportunity on the horizon.
And it remains a risk.
Thanks, Chair Powell. Kellyohgee from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't react to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation, and it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now, and we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, that's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now, and we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong, though. that, you know, it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track. And, you know, I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, I'll take that. I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways. You know, appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have.
My computer just went down, guys. My computer just went down, guys. Testing. Am I still on the line? Somebody text back. More money. Can you hear me? All right, cool. At least that's good. Heck of a day. Market has dropped 12 points today. The SPY has dropped 12 points today. Nuts. Can't see the chat. Man, let me tell you what. The way this is going down, woo-wee. The way this is going down, people about to start going back under the tree, taking the gifts that they already put up under the tree because they need some of that money back. They about to start snatching some gifts back from under the tree. They looking like, well, Johnny don't need this. He got 3 gifts all. He got 3 gifts already. These extra 2 gotta go back. All that money they spent because they was just up at all-time highs last week. My goodness. Some people on suicide watch. Some people is standing in the refund department of customer service right now trying to exchange somebody's gift. Get their money back. This is unbelievable. Unbelievable. But I'm so happy because we now have levels. Man, I even got to straighten my levels out some more. This is unbelievable. I just wish I would have made more money. That's my only thing. I wish I would have made more. Clearing out levels, putting new levels. This is nuts. Still 15 more minutes to go. This is in freaking insane, guys. Yeah. Yeah. I just erased these levels earlier.